art of selecting the strike price. Guys, grab a pen and paper. In this video, we're going to reveal you something that you absolutely cannot trade options without, and that is understanding how to select your strike price. Here's the insane truth. Many traders suffer from good trade, bad strike situations. In this video, we'll show you on how to get better on selecting your strike price so that you can lock more gains more often. Have you ever been in a situation where you were like, I just knew this damn piece of shit stock was going to drop. I knew it. I just can't believe as soon as it hit my strike, it bounced off. I couldn't even have time to collect my gains, and the thing just went higher. Man, with my luck. So this is how it generally goes. With my luck, blah, blah, blah. Ton of hundreds excuses. Guys, can you relate to this? Look, it happens to the best of us sometimes. But once you understand what to do, your job as a trader becomes a lot easier. So, in other words, when you have a situation like this actually tells you you're a pretty good trader, and all you got to do is just tweak a few things a little bit. You actually got the direction right. Getting the direction right is about half of the puzzle. So, you still lost money. So, that happens because of the poorly selected strike. And guys, it's highly, highly frustrating. So, basically, that really means that you got the trade right. You still lost money. Sucks. So let's go through a couple of scenarios here. Scenario number one that I want you to walk through with me is imagine that your account is at $2,000. And we're going to take a look at a hypothetical trade, and then we're actually going to walk through a real trade that we've suggested in our 13 Markets Move daily analysis. So here's the deal. This is an option chain. We're looking at a stock that currently trades at 160 bucks. And you're expecting the stock to actually drop today. As you know, with a lot of videos, we trade weekly options, so a lot of these trades like that, we put them together on like Thursday or Friday, Friday being the day of the expiration, where you can actually utilize that last day of expiration to your advantage to produce some really nice traction as far as your percentage of returns by controlling your costs. So let's just walk through this example. These are hypothetical numbers. They actually 175 strike put role play that it costs you right now 15 bucks. The 170s will cost you 12 and a half. The 165 puts will cost you 8. 160 puts will cost you 6. 155 3 bucks. 150s just $1, guys. What a nice round number, just $1. And the 140s, man, 50 cents. Guys, can you only imagine how many of these 140 puts can you get, even if you got a $2,000 account? So this is the real life situation, guys. And I want you to really, really pretend that you got $2,000 in your account. I really want you to answer this question. Knowing that one put, 175 strike is actually going to cost you $1,500, would you consider this strike? Knowing that the 170 put will literally translate in a cost to you of $1,250, will you buy this one? The 160 is a $6. You can actually buy 3 of them, okay, and still not spend your whole account. Okay, so you can spend $1,800, get 3 of those. 155s, oh man, this is where things get really interesting. So let's walk through this. 155 struck, they're $3. I can buy like 3 of them and only spend $900 bucks. Now this is getting a little bit more interesting. How about the 150? Man, now I'm really interested in that one. I mean, I really am, because just think about it. I can buy 10 of them with just $1,000. Oh, hold on. No. This is the real trade right there. Hold on. I'm seeing it. I'm seeing it clearly right now. Okay, 50 cents. These 140 strikes. 50 cents. I can buy 20 of them. I can buy 20 of these things. Forget this. Who in the hell would want to buy this 175 strike? Cost me $1,500 for one. I mean, who would want to do this? This makes no sense. I can buy like 20 of these 140s for just 50 cents. I like that. I like that a lot. So, question is this. Which strike would you choose, and how many contracts would you buy with the small $2,000 account? And now, as soon as you get a mental answer in your head on this, I want you to consider how many contracts would you buy in what strike if your account was 100,000. Okay, so let's look for this scenario. Okay, now your account is at 100,000. Hold the answer in your mind to that initial question with a $2,000 account. So now your account is at 100K, guys. Let's look for this example. So same situations, okay? But you got 100 grand. I mean, would you be buying 1,000 contracts of this 150 strike put? Would you be buying 1,000 of them? Or would you be buying maybe these 175s, maybe like 10 of them? What would you be doing with a $100,000 account? Which strike would you actually go with? So, same conditions for this $100,000 account, right? Stock currently trades at 160 bucks. You're expecting the stock to drop today. Let's get real for a second. Let's get 100% real. I've run this test with many traders and asked them this question in the past. And so most of the traders, they give me an answer that in the event, in the first example, when the account is at $2,000, they were likely to buy the 150 strike. So now it's your time to confess. Put it in the comments if your answer was, man, with a $2,000 account, I was going to buy 10, 20 of these 150 puts if I was certain the stock was going to drop. So it appears if we study multiple traders with small account, they would rather buy more quantity. They would rather buy more quantity, cheaper priced contracts, and that's how they expect to make the money. Okay? So everyone runs into this temptation, guys. Especially when you dream of taking your account to, from 2K to 25K in one trade. Or maybe especially if you got some pressures like your rent is due, your mortgage is coming up. Or maybe both of them, right? I mean, maybe you're trying to take account higher and some bills are due. So, guys, here's the reality of life. Everybody runs into this temptation, but you have to acknowledge and understand this because if you had a larger trading account, trust me, you would not be buying 1,000 puts of this 150 strike. You would go for a more conservative, more higher probability trade. You would be more likely buying the 175, 170 strike if your account was larger. So if you're actually trying to get to a larger account, okay, the next time you're placing a trade, please remember this easy psychological catch. Your mind is going to try to trap you into these easy reasoning that more contracts, cheaper price will make you more money. Just don't let your mind win over you in this situation. So don't buy many cheap contracts out of the money if you want to have a 100K plus account at some time in the future. So let's focus on the real answer to actually proposed question. So I've just briefly described to you the mentality and how the size of your account could actually steer you in the wrong direction when you're trying to trade options. So now let's actually focus on the real answer to the proposed question. Which strike would you choose? Well, in reality, it has nothing to do with the size of your account. It actually has to do with the context. You simply cannot answer this question without understanding the context, guys. And here's what we mean by context. Number one, you absolutely, when selecting the strike price, you absolutely have to understand the magnitude of the drop that you're calculating. So there's need to be a number of calculations done under which conditions you're placing the trade that tells you how big of a drop you're actually expecting. So clearly, if you're only expecting a $5 drop, you wouldn't be buying options way out of the money. But most of the traders, unfortunately, they never do any kind of calculations to arrive, well, by how much can something actually drop? And so in a later point in this video, we're actually going to just give you some basic understanding on how you can do it without keeping things too complicated. So what are the recent levels on various time frame charts is the second part of the context. So in other words, you wouldn't expect a stock to all of a sudden drop by 30 bucks if historically you were to pull up multiple time charts frames and it never happened before. I mean, that would give you a very low probability of a stock actually dropping 30 bucks. So keeping these things in mind and actually looking through various time frame charts could actually point out to you what may be a higher probability strike. And the third one, the most important one that gives you the overall strategy of when to trade options out of the money, in the money, how much time to give yourself on these trades, really lies in our 13 markets move formula, and a part of the formula where we spend a lot of time talking about the VIX environment, how you should be utilizing it in different market conditions. So let's cover the basics first. Let's say you think the stock will drop to 150 bucks from 160. Let's ask you a very basic question. Should you buy 150 strike puts? Well, let me help you out just a little bit here. Let me draw this hypothetical chart. Now that you're looking at this chart, maybe that should help you nail the answer to this simple question. Looking at this chart, would you be buying 150 strike puts? So see how easy this answer becomes. Now, clearly on this chart, you see that the stock never drops below 150. So would you be buying 150 strike puts knowing that the stock will actually never drop below 150? The answer is no. So see, understanding the context now gives you a very simple answer. If we go back to the question and just say, well, if you think the stock is going to drop to 150 from 160, you should buy 150 puts. Initial response from many traders is like, oh, well, yeah, why wouldn't I? I know it's going to drop to 150. Sure, I'd buy the 150 puts. Guys, make sure you do not do that ever. Okay, just don't do it, because that actually puts you in a 99.999 probability of a loss. As a matter of fact, it's a 100% loss if we are very concrete that the stock never drops below the 150. So here's the explanation. And write this down. Okay, this is the basics. If you trade options, you absolutely have to understand this. Your strike price should never coincide with your calculated target price. So in other words, if you're calculating the stock to drop to 150, you should never be buying the 150 strike. You should always be buying a strike above your target price. So if you looked at the charts, you looked at the context, you've looked at the 13 markets move formula, the VIX conditions, so on, you put all that stuff together and you're like, okay, there is a great probability the stock is going to drop 10 bucks from 160 to 150. You should not be buying 150 puts. Here's why. Your goal is always to be in the money by the expiration by a greater amount than what you would have paid to acquire the option. So here's the breakdown to make it simple. So the example is this. If the 155 strike will cost you 3 bucks and you calculate the stock to drop to 150 at some point by expiration, you will actually make roughly, okay, let's assume that we're trading weekly options and this is the last day of expiration, the stock drops to 150, the option would be worth 5 bucks. Now, considering you spent $3, now you're selling it for $5, you will make a $2 profit per contract, or in other words, 200 bucks. You're investing $300 to get $500 back. In other words, to pocket the net difference without commissions, right? 200 bucks roughly. So here's some questions to help you visualize and understand this a little bit better. Now, let me rephrase this question. So in this prior slide, the cost of the option was 3 bucks, and you were selling it for 5. Now, what if the 155 strike cost you 4.5? Would you actually take the trade? Well, the answer is clearly no. I mean, but unfortunately, that's what most of the traders do. You never want to be in this situation when you're risking 4.5 or 450 bucks, basically, in order to collect $500 back. That's a very poor risk-reward situation, and that's why a lot of traders, they're having such a struggle getting some substantial traction on their account. They're happy to make just 50 bucks, 100 bucks, a couple of $100. It's just not worth taking the trade. Your investment of $450 to just gain 50 bucks, it's not worth it. So when you look at the risk-reward scenario like this, you don't want to take this trade. Now, here's A, B, and C, just to role play so you guys can really understand this better. What if the 160 strike cost you 5 bucks? Would you take the trade? What if 160 strike cost you $11? Would you take the trade? What if 150 strike cost you $1? Guys, just $1. Just $1. Man, I like the 150 strike. Man, it's $1. Would you take the trade? So here's the answer to this simple question, right? Clearly, if you go with the 160 put and you're buying it for $5, the stock drops to 150. Now your contract is worth $10. So you would double your money. Buying the 150 put for just $1, as tempting as it is, would result actually in a 100% loss because it would expire worthless if the price does not drop below 150. So the only trade out of these ABC scenario, right, you would want to take is this A, where you're doubling the money. Now, the 160 strike in the question B, the cost is just too much. So you're spending $11, and if the stock drops to 150 by expiration, that contract is only going to be worth $10. So you're spending $1,100 to make $1,000 back. That absolutely makes no sense, right? And of course, C, as we just discussed, it expires absolutely worthless if the stock never drops below 150. Back to the context, guys. How do you calculate the magnitude of the move? Well, the way I do it is very simple. I study a bunch of charts on different time frames. So knowledge of charts, charts patterns, divergences, your ability to look at multiple time frames to notice certain things, guys, that is highly, highly desirable. So if you haven't taken out charts and divergences course, here's a little hint. Take it now so you can get freaking better. Guys, can you imagine how much it would be easier for you to trade if you went in with every trade understanding the precision of the magnitude of the move and you got the strike correctly each time? I mean, can you think of all these trades in the past that you have taken where you got the trade right, but you miscalculated the magnitude of the move and the trade ended up in a loss? If you could have just avoided loss stand trades like this, not only would have paid for the course, it would have paid for probably your car, completely paid it off. Guys, take action. Don't trade another day without understanding how to calculate these magnitudes of the move, which we teach in our charts and patterns recognition course. Now, here's one simple thing you can do for now if you're not ready to take the course for whatever reason that may be. So do an approximate observation of the DTR, or what we call daily trading range. And you can simply do that from observing the history of the chart for the last month up to 6 months. Should give you a good idea of what the actual daily trading range in the stock is. Now I'll give you a couple of examples here. So example number one is BYND. So we'll go and examine the chart over the last couple of months. What we'll see is back preceding to June, and stock had some decent moves with an average move being about $10. And you can get this from, looking at the chart for May for BYND. Now, once we got close to June, had kind of a little of a consolidation stage here. We traded between 70 and 90 for some time, with an average daily move being about $5-6. And when we're talking about daily average move, guys, it's the time, let's say the stock opens at 90 and it goes to 93 and then it ends up the day at 87. That's basically a $6 move. It's not where the stock has closed yesterday in relation to where it closed today. It's how much does the stock travel throughout the day. Very easy to actually estimate, but just look at the chart. Now, once we transition into June on BYND, these moves become much larger. The average move being roughly about $30, because there were days when it was going up $40-50 on certain days. It was dropping $40-50 on some other days. So there it is. Your average move over this time frame is $30. So when you look over the last couple of months on BYND, your smaller move daily trading range would be $5-6. Your average move would be about 10, and your larger moves on average would be about 30. So looking at this, do you think it would be reasonable to assume that BYND can actually drop by about $10 on any given day? Well, looking at the history, it's got a strong history of doing $10 moves back in April, May, it has a strong history of certainly doing these $5, $6 moves, and it's got a great recent history of making moves, on average of like 20, 30 bucks. So yes, looking at this historical data on this chart, it's pretty easy to understand that this is not an extraordinary move for the stock. A $10 move for the stock is not a big deal. Now, let's take a look at the next example of Tyson Foods, which is another company. That's easy comparison because it is trying to get into this fake meat business as well. But what do you think about the daily trading range on TSN, Tyson Foods? If we take a look at the history of the chart, even if we go back 6 months, I mean, look at this thing. I mean, if this thing moved more than $1 on certain of these days, I mean, it was like, Christmas, New Year's Eve celebration for the stock. Look at this. Jeez, I mean, this thing does not move, okay? Naturally, I mean, let me ask you a very silly question here. Would you buy, let's say, 70 strike puts on TSN, like $9 out of the money? And the answer is, hell no. But you're going to say, but Leonardo, these puts, Leonardo, you don't understand. These puts are so cheap, dude. Oh my God, they're cheap. Leonardo, you're missing out. Let's look at this chart one more time. It trades now, at the time, I recorded the slide, right, and took the picture of this chart. It was at 79.29. Would it be reasonable to assume that over the course of a day or two, this thing can drop to 70 or below? Because that's what the question really is asking you. And the answer is pretty simple, right? I mean, look at this. Has it ever done this? Has it ever done a $9 move ever in the history of this chart? And maybe at some point, like going back 10 years ago, maybe it did. But what is relevant and where has this thing been in the last month to 6 months? Because we're trading weekly options, monthly expiration, so stuff, short-term options expiration. So what is relevant to us is the recent daily trading range in this thing. And you can see it's nothing. I mean, the $3 move is like, oh my God, what is going on here, right? So clearly, to assume that out of the blue, this thing is just all of a sudden going to make a $9, $10 move lower, it's a very low probability. But Leonardo, these puts are so cheap. They are so cheap. I can buy so many of them. Leonardo, can you just imagine? Like if this thing actually drops $10, Leonardo, I will be rich. I will not even need to take any of your courses. Man, this would be so awesome. I'll pay everything off, okay? I mean, Leonardo, you should really consider these because, oh man, I can't believe they're so cheap. Look, I can't believe I actually found these. Like everyone else must be asleep. They are missing out on this Tyson trade. Jackpot. I finally got this. All I need is a $10, $15 drop. And yes, honey, I feel so good about this one. I feel so good about this drop. As a matter of fact, honey, this is jackpot. I need you to pack your stuff now. We're going on a vacation. Guys, it never works, does it? It does not work, so don't do it. So look at the recent and past DTR before selecting a strike price. And be suspicious if options are just too damn cheap. Remember, with options, pay more, make more. Remember, with options, pay more, make more. Now, going back to the context, what are the recent levels on the various time frames on the charts, including after hours and pre-market action? So take a look at that. Okay, very basic stuff. Here's actually an example of a real trade we described to our 13 Markets Move Daily members, and specifically, I don't have the actual snapshot. I forgot to insert it, guys, so sorry about that. But it said buy BYD puts 160, 165 puts. And basically, when we described the trade, we said, look, the chart looks horrible, and now we've started to see some negative catalysts coming in, so it could easily travel back to the 130s levels. So considering this for a Friday day trade. We pointed out specifically some chart patterns like the head and shoulders. We pointed out that the stock is going to drop. And it does drop. And even though it could have dropped to the 135, 136 level, in this particular case, the stock drops 10 bucks. Okay? So, what do you make out of this? And specifically, why did we suggest the 160, 165 strike to our members? So here's the breakdown. Okay, the stock when we recommended the trade was traded at 159, 160 level. Okay, so why did we specifically chose the 160, 165 strikes? There's actually two reasons. Two reasons, guys. Very simple. Reason number one. So let's take a look at this chart. It's an actual chart. Now it's not. I'm recording this in July, but I think this was actually happening in June, latter part of the June. So after hours, we notice BYD actually gaps down about 5 p.m. And when it gaps down, it actually drops from 166 to this level of 160, represented right here by this red dot. So at 7 in the morning, pre-market, the stock actually drops all the way to 151. So when we recommended to actually short this thing and buy puts on this thing, when it was revisiting these levels of 160, 159. The reason we did that, because after you see this gap down, a lot of times stocks will run up to that gap, but they're not going to be able to break above that. So from the standpoint of technicals and looking at different charts and everything, besides the head and shoulders and the multi-top formation I was showing you in the previous chart earlier, right? All of these things added up to a good situation for the stock to drop. Now, as you can see, there were two levels, right? This level we got the 160 from the gap down after hours. This level of 151, 150 we got from the pre-market trading session. So ideal entry was this. That's when we send out this message saying, hey, buy 160, 165 puts in BYD. Now, knowing the psychology of this, especially how tempting it's going to be if you're trading with a smaller account, you are going to be tempted to buy this cheaper priced options. Now, there is a reason why we've pointed these particular contracts, 160 and 165 strike. Because they would make money simply if the stock just revisited those levels established pre-market, this 151 and the 150 level. And at that point, if the stock drops even more, then these contracts are going to get substantially more traction and you would get 3, 4, 500% return. Now, the worst possible outcome is the stock drops back to the 150 level, even 155. So the worst outcome is you would break even on the trade or just maybe make a little bit of money. So those that did get the strike correctly, ultimately the stock did drop that day to 152. And so those contracts were profitably close to double in the money. Now, some guys, we actually, despite of us specifying the stock, the strike price, they were tempted. And you are going to be tempted, guys. So I'm not making fun of anybody. Like, that is just so real. And, you know, if you're a trader, you should be able to relate to that. 99.9% of the traders should be able to relate to this if you're trading options. So most of the traders disregard this particular strike price. And again, the idea was the stock had very low probability actually breaking above the 160, but it had a very high probability of revisiting those levels that were established in the pre-market section, with even a greater probability of dropping further. It didn't happen on that particular day. The stock did drop, well, like the next day after that, to like a level of 145 or so. But basically, by selecting the correct strike price and by doing your analysis and calculations in the chart, you'd have completely eliminated any losses, number one, and you would have definitely locked in some solid gains. And if the stock dropped even further that day, then your gains would have been much, much substantial. The second reasons why we chose those contracts in the money or close to the money is because of the VIX environment. And so if you want to learn and understand in depth the power of utilizing the VIX environment, guys, we spend a great amount of time on that in our 13 Markets Move formula. So I'm not going to give you all the secrets. I've just shared some really cool stuff with you guys here. Some freebies on how you can make your life easier in selecting the strike prices as a day trader or a swing trader. If you'd like to learn more information so you can trade with even greater precision, guys, I simply invite you to come check out our site, tradingoptionslive.com. Click the links below this video to get some free training. With that said, guys, happy trading to each and every one of you. I'll catch you guys on the next video.